You think you make logical decisions with your money. The data suggests otherwise. Let's run the numbers. We have a blind spot. We see the success stories. We don't see the failure stories. This is survivorship bias. It's not intentional. It emerges automatically from how data is collected and how success is visible. The winners write books. The losers fade into silence, so all we read about are winners. When a mutual fund fails and is liquidated, it disappears from historical databases. Only the survivors remain. This creates a measurement error. The average performance of surviving funds looks artificially high. The question, how much of the apparent outperformance is real skill? How much is survivorship bias? The research is clear. Survivorship bias inflates historical returns significantly. Elton, Gruber, and Blake quantified this in mutual fund data. The bias added approximately 0.9% per year to measured returns. Small number? Over decades, 0.9% per year compounds into massive wealth difference. The magnitude of bias increases with study length. Longer historical periods mean more time for failures to occur and disappear. This is why recent performance is less biased than historical performance. There hasn't been time yet for failures to disappear. Here's the problem for an investor. You look at 30 years of mutual fund performance. The top performing funds jump out at you. You think, I should invest with these managers. Their skill is proven. But what you're not seeing, 100 other funds started with the same strategy. 95 of them failed and were liquidated. You're only seeing the 5 survivors. The 95 failures, their stories are erased. They're not in the database. They don't exist in the historical record. So your proven manager? The fund survived, that's all. Survival doesn't prove skill. It could be luck. The fund happened to make good bets when the market cooperated. Brown, Getzman, Ibbotson, and Ross found that survivorship bias creates spurious return predictability. Patterns that look real are actually artifacts of the bias. The appearance of persistence in returns, funds that outperform one period continue to outperform, is partly survivorship bias. The underperformers dropped out. Of course, the survivors look persistent. Application to an investor. When you study historical performance, ask this question: what part is skill? What part is survivor bias? You can adjust for survivorship bias, but only if you have data on the funds that cease to exist. Most of the time, you don't have that data. The historical record was never compiled for the non-survivors. This is the structural problem. Success is visible. Failure is invisible. The ratio of visible to invisible determines apparent success rate. Here's the implication. Past success does not guarantee future success. Past visibility does not prove underlying probability of success. The successful fund strategy that you're copying, maybe 5 other investors tried it, 3 succeeded, 2 failed. You're only reading about the 3 winners. The 2 failures don't speak. They gave up investing. So the true probability of the strategy succeeding is 60%, not the 100% implied by the narrative you hear. The boundary, survivorship bias, is not a complete invalidity of past performance. It's a distortion that needs quantification. If you have good data on the complete cohort, successful and unsuccessful, you can estimate the true probability of success and the magnitude of skill. But usually you don't. You have survivorship bias data, and it's biased upward, always in the direction of making past performance look better than it was. The research offers one useful guideline: use recent data when comparing manager performance, not long historical records. Recent performance has accumulated less survivorship bias. There hasn't been time for weak managers to disappear. Additionally, be skeptical of long-term track records that are perfect or near perfect. They're suspiciously clean. When a manager's 30-year record shows almost no down years, consider, did they have superior skill, or did the weak years get deleted when weaker managers liquidated? Survivorship bias is not obvious, it's not deceptive, it's structural, and it's nearly impossible to fully correct without data you probably don't have. So here's the practical takeaway. Past success is weaker evidence than you think it is. Future performance? Even weaker. Correlation between past and future manager performance is modest and statistically insignificant in many studies. A manager who outperformed for 10 years might outperform in the next decade, or might not. The past doesn't predict with the confidence implied. This is where diversification and low-cost indexing enter. If you can't confidently predict who will outperform, don't bet heavily on any single manager or strategy. The market index survives all survivors and all failures. It owns everyone. It has the data on what happened to the non-survivors. The resolution, survivorship bias, is a reminder that past performance data is distorted. Don't use it as a crystal ball. Use it as a calibration guide. Discount past performance by survivorship bias. Add uncertainty to your prediction of future performance. When you read about past investment success, mentally add, and there were probably 20 other strategies that looked equally promising but failed. That mental adjustment changes the estimated probability of success from what looks like 100% to something closer to 5%. Application. When evaluating an investment strategy or manager, consciously account for survivorship bias in the track record. Ask, what's the track record of all investors who tried this strategy, not just the successful ones? If you can't get that data, be skeptical. The impressive track record might be survivorship bias masquerading as skill. The paradox: the better the track record, the more likely survivorship bias has inflated it. Outstanding long-term performance is what you'd expect to see in a world where some participants failed and disappeared. So here's what to do. Diversify across multiple strategies and managers rather than concentrating in the proven winners. Use low-cost index funds as your core holding. The index has no survivorship bias. It includes everyone. If you want to invest in active strategies, keep the allocation small, except that you can't reliably predict future winners. The evidence isn't there. Most active managers don't beat their benchmarks after fees. And much of the outperformance of those that do beat their benchmarks is attributable to survivorship bias and statistical luck rather than skill. The practical implication: build an investment plan that assumes most active strategies won't work. Your baseline should be, I'll own the market through low-cost index funds and anything else is supplementary and experimental. That baseline beats the survivorship bias stories most investors tell themselves. Don't fight your brain, engineer your environment. See you next time.